You might have seen that a bunch of accounts saying that Michael Burry, one of the characters portrayed in the movie The Big Short, is taking a $1.6 billion short bet against the market, and that this represents 93% of his hedge fund's value. Oh my God, the signal to sell all our investments is here. Well, not so fast. Let's break down what they're saying and why they're completely wrong. You need to be careful who you get financial advice from on the internet. It's episode 557. Hi, my name is Preet, and I'm a consultant to the wealth management industry and former stockbroker, and this channel is for anyone who wants to learn more about investing and the world of money around us. Okay, so let's dig into this news that has been making the rounds lately, and don't worry, this will be evergreen because it's happened before and it will happen again. Now, if you saw the movie The Big Short, one of the main characters was Dr. Michael Burry, who put on a huge short position on the subprime market and ultimately was proven right when the bubble collapsed as part of the great financial crisis in 2008-2009, reportedly earning himself over $100 million and $700 million for the investors in his hedge fund. And when your story is big enough that Batman plays you in a movie, people tend to remember your name. Now, his current hedge fund just filed what is called a Form 13F. And this is a regulatory disclosure that any institutional investment fund in the U.S. is required to file on a quarterly basis once they are managing more than $100 million. Now, this form lists the holdings as of the last day of the reporting period, and reporting periods are calendar quarters, but they have up to 45 days to file the report, and funds tend to take all 45 days to file because they don't want to give up any information to competitors until they absolutely have to.
You stop sending me information, and you start getting me some.
But the reporting lag is important, and we'll circle back to that. Now, the contents of these forms are made public, and anyone can look them up online. You can find them on the SEC's website and various other places. And if we look at the filing for Scion Asset Management, which is Burry's hedge fund, we see this. Yes, there are two large-looking positions. Each is a put option, and put options are basically short-term bets that the underlying securities will go down. And in this case, the underlying securities are index tracking funds for the S&P 500, one of the main stock market indexes for the U.S., and the other is on the NASDAQ 100, which is another popular stock market index. So again, to be clear, these represent bets that these stock market indexes will go down in value. And yes, if you look at the percent column, which represents the relative size of these positions in the portfolio, these two numbers actually add up to 94%. The difference is likely due to rounding, but this is why people are saying that 93 or 94% of his fund are basically giant bets that the market will go down. It's in an official filing. But those headlines and commentators are wrong. If that were actually the case, yes, that would certainly be newsworthy. That would be a massive outsized bet on the markets going down with no room for error because almost all of his investors' money would be put towards such risky bets that could end up worthless in a very short time if he's wrong. So he must have a lot of conviction, right? Well, he might, but you wouldn't be able to tell that from these numbers. So here's why some people are wildly overstating the significance of these puts. When it comes to disclosing long options positions on a 13F, either calls or puts, you are required to list the notional value of the position, not what you actually paid for the option contracts, or even what the option contracts were worth on the last day of the reporting period. So what is the notional value? I'm going to make it super easy to understand even if you've never seen an option quote before, and don't worry, it looks way more complex than it is, but I'll break it down. Let's look at the price to buy a put option right now on the S&P 500, which you can do by buying a put option on an index fund that tracks the S&P 500. And one of the most popular index funds for doing that has the ticker symbol SPY. And the slang on the street, Wall Street, is to call them spiders because the official name is the SPDR, S&P 500 ETF Trust Units, and I'll just spell out the ticker symbol to not be pretentious. SPY is currently priced at roughly $444 per share at the time that I'm looking at this, and if we wanted to make a bet that the market will go down, we could buy a put option with a strike price of $400 per share. Buying that put option means we are buying the right to sell SPY at $400 for a set period of time. Why would someone do that? Right now, that ability to sell SPY at $400 would not be worth much because the price is $444 per share. But if the market did drop by more than 10%, we would be in the money because SPY would be priced below the strike price on this put. So even if it dropped to $300 per share, if we have this put option, we'd have the ability to sell it for $400. So having this ability would be very valuable if the market did indeed drop a lot. But the price of this option is only 66 cents per share. Now, one quirk of option contracts is that while the contract price is shown per share, each contract is for 100 shares. So if we bought this, it would cost us 66 cents times 100 shares, which is $66. And we'd effectively have the ability to sell 100 shares of SPY at $400 each until the option expires. Again, that would be worth a lot if SPY goes down a lot, and it would be worthless if SPY never got down to $400 before the contract expired. So here's the really important part. Our outlay was $66. But if we were filing a 13F form, which we don't have to as individuals, we would have to report the notional value of this contract, which would be the underlying security, SPY's price, times 100 shares, which is $444 times 100, which is $44,400. Okay, so let me say that again. We spent $66 of our money, but we had to report a holding value of $44,400. This is a huge point to understand when trying to figure out the actual importance of these short positions that everyone seems to be excited about. What that means is that Michael Burry has not committed 93% of his investors' money into short positions that could expire worthless. Now, if we use this same ratio in our example of this option contract price to notional value, the notional exposure of Burry's puts, valued at $1.6 billion, might have only cost $2.4 million and change. So while the fund's total holdings are reported in the filing as $1.736 billion, that includes the $1.6 billion notional exposure to these puts. If we remove that $1.6 billion in notional value and replace it with the actual money at risk of $2.4 million, that's far more reflective of reality. So instead of saying that Michael Burry has put 93% of his portfolio in shorting the market, or that he has put on a $1.6 billion bet that the market will go down, it would be far more prudent to guess that maybe 2.1% of the portfolio are in these market short positions, or maybe $2.4 million has been committed to this short bet. Now, for clarity, I came up with those numbers based on a simple example using today's put option price for a 10% out of the money 1 month put on SPY. In reality, he might have a series of option contracts with different strike prices, expiry dates, and prices that could be higher. But those positions are going to be much closer to 2% of the portfolio than they are 93% of the portfolio. And that is more like a short-term light hedge rather than a doomsday, sell everything, quit your job, buy guns market call. One last thing. Remember I said that these 13F filings are allowed to be filed 45 days after the reporting period? That means that these short positions could have been unwound weeks ago. And maybe just one more last little tidbit. While you have to report if you bought calls or puts, you don't have to report if you wrote calls or puts or have shorted stocks. So you might never know if he hedged those shorts by writing other options. In fact, it's possible that a hedge fund could be short the market, but because you don't see short positions on a 13F, they could actually be long the market. So there you have it. If you like this video, don't forget to hit that like button and subscribe to my channel for more content like this, and I'll see you in the next video.